Welcome to TradeTheMBI.com. This is John's reports for the 22nd. So we're about to approach Thanksgiving. You can see that we've had these weakness signals and it had been a soft MBI, but nothing terrible in the sense that pretty much price is held at the 61%, quite effectively so. And there's been very little as far as any movement, and that's simply the reflection of this change from the idea that inflation may have eased off and be done, in which case the market is sort of like in pause because that's both a good thing from at least there won't be more tightening by the Fed, maybe. And secondarily, though, how will the economy be doing anyway? Because the reason that inflation isn't increasing is a huge drop off in demand. And that's not something yet reflected in the numbers because the numbers are going to be skewed because, again, they're going to be higher because of raised prices, not necessarily because more goods were sold. So that becomes one of those things that the number bean counters have to really make adjustments to. And from an aggregate standpoint, that always do that. So from a NQ standpoint, you can see still within a soft mode, much weaker than the S&P's readings from the magenta still falling with white, and now we have an upturn of the white MBI here, which could lead to a little bit more. So softer from an NQ standpoint, and that may be just because it had been trailing for quite some time, and becomes pivotal because the more drag it puts on the S&P, keeps it from you know having that initial holiday bounce, which is what everyone's looking for. And when you're still holding around the 39 instead of 36, nobody's really feeling all that concerned. This was wild because, okay, so we went from being in the upper 80s now to dipping into the low 70s. That would have been significant if you're able to maintain that depth. But this is also an interesting one because this is either an extraordinary um, meltdown in demand or a huge increase in supply. And it's unlikely that it's a huge increase in supply. So, what's going on with oil being down that low? It's an interesting question. And some of the numbers coming out, we're probably going to give it a better clue as to where that really is uh, taking place from. And I suspect that it's a mix of two elements. You've got some increase in supply, but then you've got a significant pullback for people trying to save a little bit. And that's just enough to create what might seem to be inventory builds and create that softness, which only eases the burden from business standpoint and a cost standpoint. So moving to the lower side of that would only be good for economic growth, but it would be an indication that currently things may be a little suffering. So from a euro standpoint, well, we had that spike up, put in lovely positive extremes. So we just marked the low setups from that, expecting it to come back to it. This one came close to the 102 there, and then a little bit of a bounce right now, but still fairly weak from the MBI readings. It almost looks identical to what the S&P in the market is looking like. So it's interesting to see them developing such a parallel. And to me, that always speaks of intervention when you see that kind of across multiple international setups the same look. Uh, doesn't usually happen because money is in agreement on that. It usually happens because there's large forces at play. From a treasury standpoint, sort of stuck here, frozen. Nobody thinks that yields are going to go down anytime soon, but they may not be going up either. And in this particular case, this is a halfway median point. There's still more room, I think, to the downside for TLT simply because of the possibility that rates aren't going to go any lower. They're just going to remain static, if not still increase. And I think that again, you have to take into some consideration that the potential is that the Fed may be wanting to normalize rates to keep them higher than many people expect because they're just so used to being down in the 0 and 1% range. So I think it's not inconceivable to think that they'd love to be in that 4.5 range just to have flexibility when the next situation occurs, which it will. From a gold standpoint, we've softened up quite a bit and still fairly weak. I mean, again, look at that. The market is identical to what we're seeing from the broader markets. And we don't normally get that. That's why it became noticeable to me, because you don't usually see that. And then when you get outside of regular markets and we move to Bitcoin, you can see how dramatically different a daily looks. Not even close, because there's just no interest in that. And you can see the structure continues to suffer, even with the bullish attempts that started right there just below the 23, couldn't break over the 23, which continued. And then once that pivot, obviously your expectation is to move all the way back down to that 14.9 range. And there's just continued problems. I mean, as you see it spread out, it's becoming a confidence issue as to whether or not there is stability and or safety in some of these platforms. And right now, people are starting to question it. Potentially about to break 1,000 again for Ethereum. That would be an interesting test to come back to these previous lows. Right down there, just right about 1,000. So that would be a huge psychological thing if it does break below that. I think that you would add to your confidence issues within it. And you can see from a 50K standpoint, we're just pretty much going sideways. We're not really doing a whole lot of anything. So nothing really special is taking place there. Intraday, I think, is more interesting. We had some nice run-ups. Created some positive extremes within those. So the expectation was, when this is pre-market, so I was just looking for the market to trade within the range with the potential of moving down to this lower previous one that still needed to be filled at 39, 38 range. So in my view, it's like, okay, I've got my top range, 39.92, with the bottom range down to the 38. And that was the premise that I took. And we ended up getting nice run-ups and some nice rundowns. I love looking for my spikes of white, particularly over the 33 level, because I know I'm going to get my return back to zero. And we ended up with quite a few of those trades, both long and short. Going back, some of them were brief turnarounds, and that's what you're going to get when you have a typical mean reversion market, which I think this has behaved somewhat like that. It's been rather kind as far as modest trend moves, not that much chop. And that's simply because with the holiday trade, you have much lighter liquidity, which means that they're able to push one direction a little bit longer. And usually you get a little bit more of a signal of a turnaround beforehand. I thought this one was interesting to point out. Coming off the short here, we had the spike of the MBI white, fine, hit the zero, no problem there. And then on the run up, we ended up with another MBI white setup going in there. And so, of course, the classic short setup is that DOC spread, the breakdown there. But what ends up happening is we get to that lower point and you end up with the dip of the orange. But all it did was take us back into the same range. Now, some people would be freaking out, wanting to cover, thinking that the original signal was wrong. But with MBI white still leading, now if magenta was over the white, I'd be less inclined to think that the rally would stop. From my viewpoint, when you see this kind of setup, it's really just a pop to try and force short covering and to fool everyone. It's almost, in a way, a shakeout version. Because with that white leading, as soon as the magenta pivots lower, is an opportunity to either add to a position, or if you were to get in big way. And that happened pretty quick right after the turnaround. I usually like to wait for the first pivot, particularly if white's going up. That gets me in a little early. That can be problematic because sometimes you can get a pivot back up of the magenta and start a new rally up. But from my viewpoint, it's like, wow, but I get in so much earlier and usually face almost no heat in those. And if you do face any, then it's likely that it's going to turn around and continue to the upside. But as you can see, that white MBI suggested a move to the 0%, which is all the way down here. So from a risk to reward standpoint, I was looking at going towards, the 50 range, from an entry that was all the way up to the 64. So, 14 quick points is what I'm thinking with this one, and sure enough, did it. And what was interesting is it got in between that secondary uh, low point, which still needed to be filled. So I thought it might take it down there. It didn't quite go that way because magenta popped back up above, but red was leading. So again, this was one of those where I had a friend here who was wanting to learn more about it, and he watched me short into this rising bar and was like, "What?" And then, as I pointed out, this situation where that white really foreshadows a much weaker setup, and what we've had is a huge run up of the magenta well into what was that number 50 51. Pretty extreme. Now, it could stay up there and continue to build, but I was still looking at a broader view of the day coming back down to that 39, 38 range. And it was just a matter of when it was going to happen. I was fairly confident that it would. And at least from a DOC standpoint, not a whole lot happening. You do have a fade of the green. What was interesting to me was this here, the rejection. When you have it sort of like when it almost crossed uh, the spider effect, and immediately was seeing the rejection, and that's why I was fine shorting into the rising bar. In fact, to me, I was excited because it was just like, oh, they're just letting me have a better entry. And sure enough, I mean, literally, that cyan green rejection, particularly with the green crossing below red, and boom. And literally, it was interesting because it did bounce around quite a bit. You came down to within two ticks of the 100% at this particular stage, and then it sort of wobbled a little bit before dropping all the way down and filling that positive extreme um, from what the expectation was. So that range from the 92 all the way down to the 38 filled as expected in advance, knowing exactly what we were, expecting to see from the market, and it performed right in line with that. So um, just throw that out there because it's one of those where whenever I see that yellow spike coming through there, I'm expecting that move to the low. It's not always clean; it doesn't have to be. That's not the point. The point is that you have a broader expectation, and you're able to wait for it to finally execute its meaning. When you see something like this, where you've got cyan under red, a lot less power associated with any short that's going to come with that. And in this case, yes, you did get a nice short to the 50%. That would be all that my expectation is in that view because I was already so significantly above at the 100% range. So it's worth noting the subtleties of those differences. But again, even when it happened over here, expectation is still the zero. Now it did hit zero, but it hit a rising zero. It actually did fill down towards the lower portion of it, which would have been right here. Did that in the pre-market, but even at its raised elevation, just a little bit higher. So again, I like pointing it out because it's effective. So I will look for you on the Skype chat. Of course, we're going to have Thanksgiving and we'll be off for that. So we'll have Thanksgiving off. And I know there's a partial day Friday. If I do a report, I may include it for the Friday because it'll only be a partial day of trading anyway. As always, though, trade well. We'll talk in later.